Howdy, Jacob here. Today we're looking at Pacific Airport Group, ticker symbol PAC. So another uh, airport company. They manage, operate, and develop airports primarily in the Mexico's Pacific region, headquartered in Guadalajara, Mexico. Market cap of almost 8.7 billion with an enterprise value of 7.8. So less debt on hand than cash. Like, gotta love that. $402 million dollars in revenue in 2013 to 1.4 billion in 2022. Pretty good returns on invested capital here. I'm seeing outside of 2020, the lowest was 9% and as high as 17%. So low teens, it looks like. Return on invested capital, pretty great. Likely well above their weighted average cost of capital, and a great place to be returning or giving investors a good return on investment. Also, again, increase in gross margins and huge margins. So operating margin from 45.3 to 50.5, gross margin from 48.5 up to 55.4. So great margin business, very solid return on invested capital. Not a lot of net debt here. Let's see. I'm not sure how that enterprise value was calculated. So 1.6 billion long-term debt and about 600 million cash on hand. Let's see what that 1.6 billion is in relation to cash flow. Okay, so capital expenditures have grown quite a bit at a faster rate than their cash from operations. We can see that property and plant in 2013 to 2022 is nearly 8 times greater, and the cash from operations is not even 3 times greater. So we're seeing almost flat free cash flow. 5-year average, I mean, you got COVID in there, but still, we're looking at about 200 million maybe. It seems to be 200 million including COVID, take COVID out, and maybe 250, 300. And their current dividend payout is 217 million. So for me, I mean, I don't like that they went into debt the last 4 years to, it looks like, help fund the dividend because they're not doing anything else with their free cash flow. It looks like the last 2 years, at least, they bought back a little bit of shares that were hopefully cheap. But outside of that, they're yearly just using their free cash flow to pay a dividend, which again can be frustrating when you have a company that has great return on invested capital. But it's frustrating when you look at it from this perspective. Maybe if you actually were to dig into it, they don't have a lot of growth potential. And so they're just giving back the money to their shareholders because they have no place to actually invest to get these types of returns. I understand that. It's like Apple having a 40%, 50% return on invested capital, but what are they going to do with the 100 billion a year they get in free cash flow? That's more than probably 99% of more worth than 99% of countries. 99% of companies, not countries. So it's like, what are they really going to do to invest to get that 50% return? It's tough. And so, I mean, to me, it seems like it's not that big of a business. Again, I don't know necessarily the size of the Mexican like primary airport business. So when I do a bigger deep dive on the company, I'll have to look at that. But it's not great to see that they have no investments in their on their cash flow statement, and really just a lot of their excess cash going towards paying a dividend, and that their debt has increased every year since 2019 or 2015. Sorry. So since 2015, they've been using their cash and their free cash flow and debt to help fund a dividend, and I guess really just increase their cash balance. I don't know why they would necessarily want to do that. Maybe they're thinking they're going to make an acquisition over the next couple of years, but it seems weird that they'd be just going into debt to harbor more cash on hand. So interesting idea and capital allocation there. But I think I'm ready to start making some assumptions. I think growth wise, it looks like they have a lot of growth potential. So I'll probably put them in the 5% range, and then return on invested capital is still good, but they're not reinvesting anything, it looks like. And so, yeah, there's still going to be growth after 5 years or 7 years. But to me, they don't really deserve that big of a premium because they're not reinvesting it. And so if we go to margins here, 31, 25, I mean, I might do 28, 25, paying back shares. It's always weird stuff with foreign companies and shares outstanding. So let's keep that flat, or I guess 0.5% shares. Their dividend, I mean, again, they're just paying it all out. I almost want them to, cut it almost in half. Let's might get some stuff for that, but to me personally, I want this company to be reinvesting back into the business. And I mean, if they're not, they're not. I understand it, but to me, that's what I'd want them to do. I think even a $217 million payout for their dividend is a lot. It's almost 100% of their free cash flow here, and so I think that can they afford it? Yes. Is that the best use of their cash? I would likely think no, even just looking at the numbers here. If they do have a way to reinvest back into the business, they they are able to do it at a great return that is beyond just giving money back to shareholders likely. And so to me, I'd want them almost to cut it in half. Whether they do that or not is a completely different story. They're at 4.9%, cutting in half will get it, under that 2.5%. But I'm fine making that assumption right now. I think that if they don't cut it in half, then there'll be a different way of getting to this valuation through less returns over here. And so I think I'm comfortable with these assumptions. To me, the company's stock price is going to have to fall 41% to get to a 15% return given these assumptions. I think it's a solid company. I don't think that I think the business is comfortable paying out a dividend with everything they produce in free cash flow. But to me, I don't want that. I want, especially if I'm in retirement, I want cash flows that are very reliable, very redeemable. They're not going into debt to produce these cash flows. The payout ratio isn't excruciating. And again, this is a company that's producing very solid cash flow with great, fantastic, wonderful margins. And they have good returns or good ability to grow through revenues, but and margins. They've been historically been seen to increase margins. But to me, the payout's too much. I want them to cut it in half, which would mean less than 2.5% dividend yield. Is that still well above market? Absolutely. I think it's still a good company to add to your dividend yield screener list or dividend stock screen list. But for me, I'm just waiting for it to get to a price that makes more sense. And honestly, I would wish that the company this one hindered me from investing in it, but I would want the company to use better allocation if they're able to do so. And if it gets to a cheap enough price, I'm willing to buy nearly anything. And so if the current stock price were to be $40 a share, it wouldn't really matter what the company did with their free cash flow because the likely price appreciation, given their balance sheet and free cash flow, they're going to survive. They're going to make it through, and the use of the dividend is perfectly fine. Even though at that point they should be buying back all the shares they can. To each their own. So yeah, hopefully everyone had an enjoyable time listening, and hope you have a good rest of your day. Thank you. Bye.